What happened to Guangdong, China's economic bridgehead? China's short-term financing rates soared abnormally, policy intervention caused market chaos. China's foreign direct investment goes negative for first time in 25 years. Xi Jinping confiscated assets of elder statesmen, triggering a total rift with powerful families. It's all covered in today's China Truths. What happened to Guangdong, China's economic bridgehead? Guangdong, being a pioneer of China's reform and opening up, has a tradition where both businesses and residents hold foreign exchange as a safeguard. Presently, they are determinedly transferring this money abroad. Guangdong is home to many overseas Chinese, and anyone from Guangdong can easily find several overseas friends or relatives. Additionally, Hong Kong, a global hub for money laundering, is conveniently nearby. In every city in Guangdong, there's a well-established and reputable underground banking system. Transferring money abroad is relatively straightforward for people from Guangdong, and it's not a challenging task. Despite the government's efforts to curb capital outflows, as long as Guangdong residents are resolute about moving their money abroad, they can do so swiftly, even if they have to physically cross the border from Luohu port. This significant outflow of funds has been the central theme of Guangdong's economy this year. Let's dive into this set of data to shed light on the current economic situation in Guangdong. According to monthly data released by the Guangdong branch of the People's Bank of China, at the end of 2021, the balance of foreign exchange deposits in financial institutions within Guangdong reached a historical peak at $167.5 billion. However, by the end of 2022, it had declined to $144.6 billion. Earlier this year, there was a brief rebound, with the balance reaching $161.4 billion in March, almost reaching the historical peak again. Unfortunately, it then took a downward turn. By the end of September, it had dropped to $136.5 billion, marking a 15.4% decline over 6 months. If this trend of foreign exchange outflows continues, Guangdong's foreign exchange deposit balance is projected to reach around $110 billion by year-end. By the end of the following year, it may be nearly depleted. In terms of household renminbi deposits, in September this year, the total nationwide amounted to 134.7 trillion yuan, representing a 12% increase compared to 120.3 trillion yuan at the end of the previous year. This reflects a natural response by ordinary people nationwide to save money and prepare for economic challenges. Surprisingly, in Guangdong province, the household renminbi deposits reached 12.46 trillion yuan in September, representing a 10.7% increase compared to 11.26 trillion yuan at the end of the previous year. Remarkably, the growth rate of household renminbi deposits in Guangdong was notably lower than the national average, a reversal of the prior trend of significantly exceeding the national average growth rate. This isn't because the wealthiest individuals in Guangdong are incapable of earning or saving money today. The only reason is this: the people of Guangdong are getting ready for an economic downturn, and there is another way: the outflow of capital. The capital outflow signifies that not only money but also industries and talent are leaving, and this is having a detrimental effect on Guangdong's real economy. In the industrial sector, as of the end of August, Guangdong province experienced a higher loss rate in industrial enterprises at 30.5% compared to the national average of 27.5%. By the end of August, there was a 4.7% reduction in the number of industrial workers in Guangdong, whereas the national decrease was 3.4%. From January to August, Guangdong's industrial output value decreased by 8.3% compared to the previous year, while the national decrease was 5.1%. In the consumer sector, Guangdong province recorded an absolute growth rate of 5.7% in the total retail sales of consumer goods from January to August, which was lower than the national rate of 7%. This indicates that Guangdong is significantly lagging behind the national average in various aspects, from production to exports to consumption. The most concerning issue is that Guangdong's tax revenue has stagnated in this context. According to quarterly data from the Guangdong Provincial Taxation Bureau, the total tax revenue collected in Guangdong Province, including national taxes remitted to the central government and local taxes, reached 1,931.6 billion yuan for the first 3 quarters of this year. However, this is only a 3.94% increase compared to the same period last year, while the national tax revenue has grown by 11.9%. It's worth noting that tax revenue has significantly increased across the country due to factors like the deferred payment of value-added tax from the previous year. Nonetheless, Guangdong's tax revenue is notably falling behind the national average. Given the current situation, reversing the tide is impossible. There are numerous changes that would be necessary to halt the capital outflow from Guangdong, and they are, in practice, unattainable. This includes prohibiting the unchecked influence of authorities on businesses, which is fundamentally implausible in China, as those in power will not willingly limit themselves. It also involves ending the monopoly of state-owned enterprises, eliminating the privileges of a select few, giving ordinary citizens the right to participate in politics, and ensuring freedom of speech and publication for the public. There are numerous other requirements in a similar vein, and the history of China's economic reforms, without corresponding political reforms, has left behind an insurmountable debt. These debts cannot be repaid, and China has no chance of restarting reforms. Therefore, we are left to watch helplessly as the situation deteriorates day by day, descending toward a grim future, one step at a time. China's short-term financing rates soared abnormally, policy intervention caused market chaos. At the end of October this year, a serious chaos broke out in China's money market, with short-term financing rates soaring to 50%. Reuters exclusively disclosed the relevant details and quoted economists' analysis as saying that the government's heavy-handed actions in the financial market led to market chaos and also reflected the desperation of borrowers. On Monday, November 6, Reuters quoted sources as saying that last week, October 31st, the Chinese banking system's routine demand for cash at the end of the month snowballed, so much so that it once pushed short-term financing interest rates to 50%. Eventually, the chaos calmed down as the central bank, People's Bank of China, the China Foreign Exchange Trade System, CFETS, and the Bond Clearing House jointly stepped in, instructing lenders to extend trading hours and holding meetings with relevant agencies to calm the market. According to Reuters, personnel from the People's Bank of China disclosed that the China Foreign Exchange Trade System was investigating abnormal transactions on October 31st, involving some accounts that repeatedly borrowed money at extremely high interest rates at the end of trading hours. The report from Reuters cited multiple unnamed market participants as saying that the chaos in the money market was caused by a combination of factors, including recurring month-end liquidity needs and cash shortages ahead of a massive sell-off in government bonds, and Beijing's orders to banks not to lend in a big way to avoid a devaluation of the yuan. The report stated that it was the government's intervention in the financial market that caused banks to be reluctant to lend, while the market still needed funds. As a result, on the trading floor on October 31st, the competition for short-term funds turned into a crowd stampede. Borrowers who could not get a loan were desperate to pay an interest rate of 30% to 50% to obtain the loan they urgently needed. However, when the market closed at 5 p.m. that day, the transactions were not completed due to insufficient funds. A Beijing-based fund manager recalled the scene and told Reuters that no one left the trading desk at the close because you don't know how things will develop. The whole trading room was in a fighting mood. The fund manager said that for everyone in the market, if you need to close positions and avoid defaults in this environment, you need to borrow money at high interest rates. Repurchase rates between banks, a key indicator of short-term funding costs, are usually stable, and on October 31st, overnight rates soared to 8% from 2% the day before. The People's Bank of China later stepped in, asking state-owned banks to provide funds, before both China Central Depository and Clearing Company, CCDC, and Shanghai Clearing House reopened for settlement at 6 p.m. As overnight interest rates fell back below 3%, fear in the market gradually subsided. By 8:30 p.m., the market was cleared and closed again. Sources who received the notice revealed that at the time, money market operator China Foreign Exchange Trade System, CFETS, told traders to keep the upper limit of repurchase transactions at 5% and said that anyone participating in the high-interest rate transaction completed on October 31st need to explain their behavior to regulatory agencies. Xia Chun, chief economist at wealth management company Intech Investment Holdings, told Reuters that this was an unforeseen consequence of the government's heavy-handed action on financial markets. Xia Chun said, "This was an accident." Xia Chun continued, "Banks were reluctant to lend, which caused non-banks to lend money to each other in afternoon transactions. As a result, lending rates soared, and some people were willing to bear any price." The report pointed out that short-term financing markets, such as overnight repurchase agreements, are crucial to the daily business of banks, insurance companies, and other financial institutions. They influence foreign exchange movements because the market is the main channel for money supply. Some market participants said that as long as capital outflows put the system under pressure, the vulnerabilities exposed by the market will continue to exist. China's foreign direct investment goes negative for first time in 25 years. China has recorded its first quarterly foreign investment deficit since 1998, underscoring the trend of foreign companies exiting the nation in response to economic challenges and geopolitical tensions. According to preliminary data published by China's State Administration of Foreign Exchange on November 3, direct investment liabilities, a gauge of foreign direct investment, FDI, dropped by $11.8 billion in the third quarter. That marks the first time China has suffered a shortfall in foreign investment since 1998 when the Bureau started recording data. The latest official data signal more trouble for the world's second-largest economy, which is faltering amid a property crisis and historically high youth unemployment for those aged 16 to 24. Analysts suggest the FDI decline is linked to China's interest rate disadvantage. Some experts believe the drop in direct investment liabilities, which track the financial transactions of foreign-owned businesses in China, is likely influenced by geopolitical tensions with the West. According to Reuters, Julian Evans Pritchard, head of China economics at Capital Economics, said the unusually large interest rate gap has led firms to remit their retained earnings out of the country. Although he sees little evidence that foreign companies are, on aggregate, reducing their presence in China, we do think that, over the medium term at least, increasing geopolitical tensions will hamper China's ability to attract FDI and instead favor emerging markets that are more friendly to the West. Worst outlook in decades. According to a survey from the American Chamber of Commerce, AmCham, in Shanghai, 60% of respondents cited the growing U.S.-China tensions as a critical challenge in China. The AmCham said in the annual report that the investment climate for U.S. businesses in China was the worst in decades. The report showed that amid U.S.-China bilateral tensions, COVID disruptions, and macroeconomic pressures, member companies report worsening business results and a less optimistic outlook for China. The report said, 2023 was supposed to be the year investor confidence and optimism bounced back after years of COVID disruptions and restrictions. The report continued, however, the rebound has not materialized, and business sentiment has continued to deteriorate. The report found, despite the end of COVID-era constraints, the percentage of companies describing themselves as optimistic or slightly optimistic hit a record low of 52%. That was the lowest business confidence level that AmCham has recorded since its first report in 1999. Last month, a report from the Atlantic Council Geoeconomic Center and Rhodium Group, a Washington-based think tank, suggested that China's economy needed structural reform. It noted, the economic malaise that policymakers in Beijing are staring down now is not caused by cyclical factors like COVID, but by a failure to reform the country's economic system. The report indicated the root problem of China's economy is its persistent structural reform gap, which resulted in lagging behind advanced economies in most market dimensions. Deteriorating business environment. Several raids and arrests earlier this year have rattled foreign investors. According to data from Goldman Sachs cited by Reuters, China's foreign exchange outflows in September sharply increased to $75 billion, the most substantial monthly increase since 2016. The challenges confronting U.S. companies operating in China extend beyond concerns like state subsidies for Chinese competitors and intellectual property theft. A fresh set of issues, including exorbitant fines without any explanation and investigations into U.S. firms, were highlighted by Commerce Secretary Gina Raimondo during her visit to China in late August while speaking to senior Chinese economic officials. What compounds the situation is the vaguely worded anti-espionage law, which went into effect on July 1. The legislation expanded the scope of espionage activities to include documents, data, materials, or items related to national security and interests without specifying what falls under national security. Ms. Raimondo said the amendment to the legislation is unclear and sending shockwaves through the U.S. community. She told reporters aboard a high-speed train to Shanghai on the night of August 29, "Increasingly, I hear from American business that China is uninvestable because it's become too risky." Since March, the Chinese authorities have raided due diligence company Mintz and consulting firm Capvision, questioned Bain and Company's staff, and investigated chipmaker Micron. Xi Jinping confiscated assets of elder statesmen, triggering a total rift with powerful families. As previously reported, Wang Huntao, a political scientist with extensive knowledge of the CCP's internal affairs, disclosed to the Epoch Times that even retired high-ranking Chinese Communist Party (CCP) officials are not safe. They have no opportunity for private gatherings, and senior central cadres find themselves essentially under house arrest. Their secretaries, guards, communication officers, drivers, chefs, and others are all intelligence agents. Furthermore, Wang disclosed that the families of former CCP leader Xing Qinghong have chosen to relinquish a portion of their assets in exchange for avoiding legal pursuit. It's important to note that presently, only two major families are declining to part with their assets, those of Hu Jintao and Jiang Zemin. All other families, including that of Wen Jiabao, have already handed over their assets. Nevertheless, the Epoch Times is currently unable to independently verify the information that has been disclosed. Commenting on this matter, Associate Professor Feng Chongyi of the University of Technology Sydney in Australia disclosed that, in recent years, the CCP regime has encountered both an economic crisis and the need for Xi Jinping to suppress political rivals. Consequently, many elite families have had their wealth confiscated, making it conceivable that major families have transferred some of their assets to Xi. For instance, Chen Xiaolu, son of CCP Marshal Chen Yi, who had connections to Anbang, had all his assets seized after Xi Jinping directly arrested Wu Xiaohui. Furthermore, Xing Qinghong's niece, who was in her prime, experienced financial troubles. She denied her a loan for her real estate company, which resulted in her bankruptcy and difficulties. It's known that Anbang Insurance Group was a Chinese holding company whose subsidiaries mainly deal with insurance, banking, and financial services. Mr. Feng Chongyi also noted that Xing Qinghong's son, Xing Wei, was notably prominent in Australia in the past. However, in recent years, he has maintained a lower profile, indicating that the financial resources of the Xing family have also been curtailed. On September 28, the authorities announced the arrest of Su Jiayin, the founder of Evergrande, who was known for his close ties to Xing Qinghong's family. Feng Chongyi stated, Xing Qinghong's family, originally associated with the oil faction, has seen numerous officials, both high-ranking and lower-ranking, arrested, beginning from the leadership of the oil system. Consequently, their assets have already been transferred to the state treasury. Additionally, Li Xiaolin, the daughter of former Chinese Premier Li Peng, has retired and exited the Chinese power structure. Mr. Feng clarified that Xi Jinping and the major elite families within the CCP have long been at odds. He revealed, in the beginning, everyone allowed Xi Jinping to rise as their co-leader to safeguard the CCP's rule and their own interests. While Xi Jinping claimed to protect the party's assets, it effectively meant preserving the assets of various influential families. However, in the end, Xi Jinping consolidated supreme power, marginalizing or even eliminating various major stakeholders and families, leading to their dissatisfaction. He asserted that at present, the major elite families and Xi Jinping have become adversaries. Xi Jinping's inner circle largely comprises his former associates from Fujian and Zhejiang, individuals with whom he had worked as a secretary and enforcer. Xi has fallen out of favor with those elite families. Scholar Yuan Hongbing, currently residing in Australia, has repeatedly disclosed that due to China's rapidly deteriorating economy, Xi Jinping has intensified the crackdown on corrupt officials and the seizure of their wealth. According to informants within the system, Xi Jinping has been emphasizing the significance of confiscating illegal finances during the purification and investigation of corrupt officials in recent times. Don't forget to comment in the section below to share your opinions on today's topic with us. If you find the information helpful, please share this video with a friend to watch together. This will be a great source of motivation for our team to produce more and more quality and reliable videos. And also don't forget to like and subscribe to see more interesting topics from China Truths. Thank you for tuning in.